Good morning, good afternoon, and good evening, friends. So let's continue with the concept and accounting of depreciation. I am on page number 9, illustration 1. Let's get into the more practical questions now. We are done with the concepts now. Let's go into the practicality of it. So I'm in illustration 1. Jane Bros. Jane Brothers acquired a machine on 1st July 2015. As we have been discussing, the dates in an accounting parlance is of significance. Students has to be sure on the dates here. So acquired a machine on 1st July 2015 at a cost of rupees 14 lakhs and spent rupees 1 lakh on its installation. The firm writes off depreciation at the rate of 10% per annum of the original cost every year. The books are closed on 31st December. So let's put the machinery account like to purchases of machinery like to bank account, right? To bank, right? To bank. Machinery account debit to bank. Machinery being real account, debit what comes in, that's machinery, and credit the given bank, right? Bank is a personal account, 14 lakhs. And we also discussed in the earlier class, like installation costs should be capitalized as well. So to bank account again, towards installation, it's 1 lakh, right? Let's put the date on which it is happening, 31st July. 31st July, right? 31st July. And the total cost of machinery is 1,50,000 now. Sorry, it's 15 lakhs now. And the depreciation is at 10% per annum of the original cost. So depreciation on year 1, I'm putting 31st December. 31st December, depreciation. This is for 15 lakhs into 10% into 6 by 12, because it is for the second 6 only for 6 months, because machinery is acquired on 1st July. So it's July, August, September, October, November, and December. It's only for 6 months the depreciation has to be charged. Total depreciation for the year is 75,000 rupees. And let's close the machinery account now. Balance carried down. Carried down is equal to 15 lakhs minus 75,000. Balance carried on is 14 lakhs 25,000. Now let's put into the let's take the depreciation to the P&L account. Now I'm preparing the ledger for depreciation account, right? Depreciation account, it's 31st December. I'm removing this format. So depreciation is 75,000 rupees. Depreciation account debit to, we discussed in the earlier class, two options, right? Depreciation to provision for depreciation account or depreciation to machinery asset account, right? Let's try the first one. Depreciation to machinery account. Machinery account. Narration will be like depreciation for 6 months. For 6 months, that's 75,000, and then this is carried forward to the P&L by profit and loss account. So the entry will be, it will be debited to P&L account. So by P&L account debit to depreciation account, right? So 75,000 rupees. This is charged to profit and loss account, 75,000 rupees. Hope this is clear, right? Let's try the next one. Let's try the what has happened to the depreciation. Okay, fine. Let's try what's going to be the depreciation for the next year. Yeah, it's show the machinery account and depreciation account for the year 2015 and 2016. Let's insert some rows here. Now we have just copying the format here. So now we have balance brought down. Balance brought down. and this is for the year 2016. Year 2016, right? So the balance brought down is 14,25,000, and depreciation for the whole year, it is 15 lakhs into 10 percentage, which is 1,50,000. So balance carried down in case of asset account is equal to 14,25,000 minus 1,50,000, right? 12,75,000 will be carried forward to the next year as the beginning balance, right? Now let's put the depreciation account. Let's put the depreciation account for the year 2016. So depreciation is transferred to P&L, right? So there will not be any carried forward balance. So depreciation for the year 2016, depreciation account debit to machinery account, 1,50,000, and by P&L account, because it's transferred to the profit and loss account at the end of the year. By P&L account, it is 1,50,000. Hope this is clear, right? So the first year the depreciation is 75,000 because it is only for 6 months, and second year it is charged fully for the year because it is for the throughout the year. And in this case of straight line method, first year we saw like depreciation is it is charged at the same amount every year. So 1,50,000 being the cost of the asset, 10% is depreciated every year. So first year it is 75,000, second year it is 1,50,000, and subsequent years it will be still be 1,50,000 that will be charged to P&L, right, onto machinery account. Now let's close into the next question, illustration 2. Illustration 2 here. Illustration 2. Let's try it out, the second one, using return on value method, I think, right? The second question is diminishing balance method. Yeah, let's try it based on the diminishing balance method. So Jain Brothers acquired a machine on 1st July at a cost of 14 lakhs and 1 lakh on its installation. The firm writes off depreciation 10% per annum. The books are closed and prepared. Same, right? The same question, but we are going to try it with diminishing balance method. So I'm calling the same format here. Copying the same format here. This remains same. Depreciation for the first year will still be 75,000 because it is at the diminishing balance method. First year depreciation is at the whole value, right? Now, in case of second year, the change comes in only in the case of second year. Depreciation will be 14,25,000 into 10%. In the straight line method, we saw that depreciation is charged at the full value of the asset. Every year it is charged at the full value of, so asset value being 15 lakhs, we are charging 1,50,000 every year. Second year also it's charged at 15 lakhs at 10%. Whereas in case of diminishing balance method, we saw that the value of the asset diminishes over a period of time. So the return on value method or diminishing balance method, the value of the asset at the end of the year will be taken for charging depreciation for the next financial year. So the end of the year asset value is 14,25,000 and beginning balance for the year 2016 is 14,25,000. So asset will be charged at 10% on 14,25,000. So the end balance of the asset will become 14,25,000 minus 1,42,500. Let us put it for the year 3 also for our reference. I am putting it for year 3 also, so that we understand this better. We understand this better. I'm putting it for year 3 here. Year 3, I'm saying year 2017, right, for reference. Year 2017, balance is 12 lakhs 82,500, and the depreciation will be is equal to 10%, sorry, is equal to 12 lakhs 82,500 into 10 percentage. So the depreciation for the third year will be 1,28,250, and the asset value will be 12,82,500 minus 1,28,250. End balance of the asset for the year 3 will be 11,54,250. Okay, so this is clear, right? How this is being charged in the diminishing balance method. And in case of depreciation, it is 1,42,500. Year 1 it is 75,000 because it is for 6 months and at full value. Year 2 it is 1,42,500, and P&L that will be transferred to P&L at 1,42,500. Hope this is clear, right? Then the third one is an interesting method, sum of years method. Let me give some heads up on how this works. This is normally not used. Most, as I was explaining in the previous class, most common method of using depreciation is diminishing balance method. Most common method is diminishing balance method. But let's try it out the other methods also, right? We tried straight line value, straight line balance. Now let's try method 3. Method 3, sum of years of digits method. Sum of years of digits method. I'll give a heads up on this now for the students to understand how this works. Right? Sum of years of digits method. We purchase an asset. Asset purchased for say 10 lakhs, 1 lakh. For 1 lakh. Okay. Years in service. Years in use is equal to 10 years. 10 years, right? Sum of digits method work like this. Sum of digits method. 10 plus 9 plus 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1. C plus 2 plus 1. And 10 plus 9 plus 8 plus 7, 6, 5, 4, 3, 2, 1. That is equal to 55. 55. Every year, depreciation for year 1, assuming that there is no residual value on the asset, depreciation for year 1 will be is equal to 10,000 or 1 lakh into 10 by 55. Depreciation for year 1 will be 10 lakhs or 1 lakh into 10 by 55. Depreciation for year 2 will be 1 lakh into is equal to 1 lakh into 9 by 55. 16,363 will be charged in year 2. Depreciation for year 3 similarly will be, depreciation for year 3 will be, yes, you got it, is equal to 1 lakh into 8 by 55. Similarly, depreciation will be charged, and at the end of the year, assuming that there is no residual value, the total value of depreciation will be equal to the total cost of asset. So it will be used for replenishing the asset. So what the if depreciation has to be calculated for year 4, total depreciation, that's it, total depreciation up to year 4, then it is equal to 1 lakh into 10 plus 9 plus 8 plus 7, that is 19 plus 8, 27 plus 1, 34 into 34 divided by 55. So total depreciation for year 4 will be 61,818, right? So let's put it here. Depreciation for year 4 alone. year 4 alone will be is equal to 1 lakh into 7 by 55. You can see here the total depreciation for the total is 61,818, or this can be calculated like this also. 10 plus 9 plus 8 plus 7 divided by 54 divided by 55. That's 61,818. Right? So this is how the sum of years of digits method works. It's more easy, but it is not commonly used because it doesn't consider the wear and tear. It assumes that every year the depreciation will be equally charged, right? Like uh, and moreover, this method is not in common use because the life of the asset can change. The life of the asset uh, um, uh, can vary. It depends upon the production and depends upon the usage, etc. Also, so it straight away takes, like similar to straight line method. It assumes that this is how it is going to work. So that is the reason this method is not commonly used. While I'll leave the students to go through this method and also the couple of problems what we solved above. And you can send an email to babupri@rediffmail.com for any queries or clarifications. And then we'll continue and try to complete the more problems and solutions in the subsequent classes. Thank you, friends, and have a great day.